Let's start with gold here right now. We've been seeing the hedge funds in particular kind of trimming their long positions when it comes to gold. Why is it losing a lot of its fury here now? I mean, have we reached the top of this rally?
Well, I don't think we have reached the top of the rally, but we also need to recognize that, first of all, prices have rallied quite a fair bit. That's number one. And if you look at speculative positions, particularly on the future side, those ones have really increased dramatically. And so that kind of increase tells you a lot of investors are already positioned. But I think any pullback in gold is actually a buying opportunity from here.
So you're still sticking to this forecast here of 1,600? Or so when it comes to gold?
I would say towards the end of the year, we're looking at 1,550, but then in 2020, we're looking at 1,650. And I think there are two reasons. Yes, short term, obviously, gold takes all the guidance from the trade talks. And on our expectation is that still there's a good chance that we're not going to get any grand deal and some of the tariffs still ratchet up and the CNY might weaken and the uncertainty spikes one more time. And here I think gold will do its job. But I think more importantly into 2020 as well, we expect the Fed to cut several times. And so real rates in negative territory. Why would you not own gold, particularly as an equity investor and investors here in the region? Gold adds extremely favorably in portfolio context.
So, Dominic, it's Juliet here in Singapore. As you say, the effects of the trade war, potential negative real rates, all a reason to hold gold. Just touching on what you said, though, about the trade talks. Of course, we're gearing up for these talks in Washington. Is it likely we are going to see some kind of positive news coming through here, particularly as Bloomberg has been reporting China seems to want to narrow the scope of the deal?
I think if you look at the equity market, which reacted quite positively on some kind of sign, there might be a broader understanding between the US and China towards the end of August and into September. I mean, a lot of pullback already. So clearly, if we have any kind of intermediary deal where, the indication is, yes, we buy a little bit more soybeans, we relax things on Huawei, and this is the beginning of a broader talk. So really, we start to see a little bit of a framework that things could go better from here. And I think in that kind of environment, the market could take that quite positively. But if it's just, okay, we're going to buy a little bit more soybean, we change things, and yeah, look, tariffs still going to ratchet higher. I think in that kind of environment, the market is going to be more cautious and might sell off. So from our perspective into this kind of environment, we want to be underweight in terms of the equities, particularly on the emerging market side. And we do look for some carry trade position that actually can weather the situation quite effectively. So on our perspective, there is obviously two outcomes. We are more defensively positioned.
So underweight equities, you prefer US stocks, you mentioned that as well. Let's talk about some of the other commodities that you cover, because we've seen a lot of these concerns about geopolitical tensions weigh into the oil market as well. At what price level do you add exposure to oil?
From our perspective, short term, we're still quite constructive. I mean, we lost quite a fair bit of barrels, 1.4 million barrels, if you believe the latest numbers from August into September. So the market is reasonably tight in the short term, but I think the 2020 is the bigger problem. Demand is going to grow maybe a million barrels per day, a little bit more, but the supply side, particularly outside OPEC, can still grow at the staggering 1.6 to 1.8 million barrels. And so the market goes into a surplus. So I want to see prices going down at least $5 per barrel before I look into it. I think once we get that kind of adjustment, I think the first step would be to sell volatility. Vol in oil is still quite attractive. And I think once you get a little bit lower price levels on the spot side, and with the curve still somehow in backwardation, I think vol selling becomes the first investment objective that I would look into. And then later on, if I get a little bit of confirmation that the global economy is not continue to sink, think about, I mean, investment is already on its knees. And the big question is for 2020, will consumption step down more broadly? And I think we still not have a lot of clarity on that side. So I still want to wait a little bit before I add, I would say, a Delta 1 position.
What about the geopolitical risk surrounding possibly another attack in the Middle East? Do you think that's being priced out of the market now? Is that the right move?
I think it's quite amazing if you think about it. We lost so much supply and the market barely reacted. I mean, first of all, it tells you a little bit that obviously the market doesn't really care anymore about Saudi Arabia being the swing producer. We lost probably an additional spare capacity. Of course, I mean, it's now 1.5 million barrels. probably thereabout. That's very, very low. But with the expectations that the US might add 0.8 to a million in crude additional supply next year per day, and then you have all the NGLs on top of it, then we have Europe a little bit more, Brazil. So all that kind of mix of incremental supply tells us, it's really the forward-looking element that seems to govern at the moment the price. And the other element is we still have ample inventories. So we do have strategic reserve, 2.9 billion barrels actually in OECD in crude, and I think that gives a lot of comfort for investors.